Am I putting your bearishness too strongly, Francis? Are you in a definite recession camp back half or just a possible one?
Well, we have a 70 to 80% chance of a recession in the second half of this year. But even though my models tell me to do that, what I tell portfolio managers is move away from the big R word. Recession or not is not the story. The story is that we're going towards a growth slowdown. The unemployment rate is going to rise. People are going to be working less. This is not a favorable economic environment. And whether we're growing 0.1 or negative 0.1 will definitely trigger recession call or not. But it shouldn't change the way that you're looking at this economy, which is slowdown ahead, problematic fundamentals that are not going to be great for risk assets.
The Wall Street Journal highlighting something that Tom McClellan was on the show talking about a short while ago, which is that hours worked are contracting. Explain the significance of that.
It is massive. And one of the reasons is we know because companies have told us that they're aware there's a recession ahead. Everybody knows this. The Fed is telling us there's a recession ahead. The problem is that we're still in a massive labor shortage, and that's not going to go away. So companies have said we're going to do everything we can to cut costs in other ways. And one of the ways they're going to probably be doing that is keeping people employed. So the unemployment rate might not rise as much, but we're going to see their demand declining. And we know that's another measure of labor demand. So a lot of economists are going to be moving away from traditional levels of labor demand and looking at alternative measures. This one, weekly hours worked, that's down. It's now at levels consistent with pre-COVID. And as a result, the other thing we're seeing is much as average hourly earnings are higher, weekly, the amount that consumers are taking home at the end of the week is declining and moving lower. This is not a great economic environment, no matter how you slice it.
And it's also significant, not just as kind of a gauge of the labor market, but itself for, let's call it nominal GDP, just like the total, the size of the economy. It shows some deceleration already, which we've already seen quite a bit of. Chris, you're breaking out the 99-2000 playbook. Why?
So, Kelly, it's a couple reasons, right? So we had our year-end price target at 4,200. We had a soft landing target at 4,400. We've sliced through both of those at this point in time. There's a tremendous amount of momentum. And what we started to look at is just the comparison between 99 and 2000 with tech, with UberCap, with technology innovation, but also with the Fed. If you go back to 99, 2000, there was another tightening cycle. But what happened was the Fed continued to tighten, but at the end, they accelerated that tightening. They went from 25 to 50. And that was the beginning of the end for the economy, for old economy stocks, but ultimately it dragged down the new economy stocks. And that's really what we're looking for. And this pause is not going to get you there. So we do think there's a pullback in the short term, but the longer term trend has not been broken. And I don't think it will be broken until the Fed gets a lot more hawkish than what it is right now.
Do you think, Francis, so one of the kind of interesting things about the market narrative lately is people thinking, okay, maybe the Fed still has to hike a few more times, even as in the market today, 1 year break evens, 172, right? So they seem to be on the one hand betting that the Fed could be more hawkish, and on the other hand, basically saying, well, that's going to break something or that's going to have this fallout that Chris is describing.
Well, there's a lot of focus on this July meeting. My team's actually split 50-50. We're not quite sure, which is, sometimes something that happens. But what really keeps us up at night is not one or two more hikes. It's what does 2024 look like? And if we're heading into a recession, and the central banks have said to us, not just in the U.S., but elsewhere, we're still concerned about a second wave of inflation. We're still concerned about asset bubbles. For the first time in my career, I'm actually saying that I don't think that central banks are going to go into easing territory. They may cut, but just to neutral. That's the real problem when it comes to how we're thinking about the Fed, is not the next couple of months, but how do they respond to a recession? And is that playbook very different than it has been for the last several recessions? And I think that's the really big problem that we're going to see. It also means that those stock bond correlations, they may flirt positive again, very challenging for asset allocation decisions.